Ladies and gentlemen, welcome to the Fintech Frenzy. Today, we got some SoFi news, we got Robinhood in the news, and we got Shift4 heavily in the news today. Anything that has happened over the last couple hours, I may have missed. So I may be looking through X or through the comments. You guys keep me up to date, but I've been following some of this politics stuff, what's going on the X platform falling through. I guess Trump might not be speaking. Who knows? But yeah, so let's jump into it, ladies and gentlemen. First off, I want to be talking about SoFi. We're going to be watching a pretty long video. I'm going to be breaking it up and listening with you guys, pausing, and giving my commentary on a recent interview with Anthony Noto that somewhat sort of flew under the radar. Someone sent it to me in my DMs, and I completely just lost track of it. And then Data Driven Investing reposted it today. I was like, you know what? That is something that I meant to cover earlier. 4.5 is late. What? I am not late at all. That was as on time as I could possibly be. Trump is supposed to be talking right now. You picked a bad time. Yeah, but he ain't. So they're 30 minutes late. Who knows if it'll ever get solved? It might not go on today. So regular scheduled programming as always. And if you guys are just watching this, it might be pre-recorded. We might already be finished the live stream by the time you watch. No problems at all. The news will still be here at your leisure. So same thing with the Trump thing. I'll just watch that later if I'm interested. That being said, ladies and gentlemen, let's talk some Shift4 really quickly. Boom. Shift4 Payments plans to offer a $1.1 billion senior note offering. Now, I saw immediately some people posting that this is a convertible note offering. Because if you read through, you'll see some, well, actually not in this post, but you'll see some articles that say that it's a convertible note offering. But no, if you actually read the fine print, this is not. But they are using this money to pay off their old existing convertible notes that are going to come up to expiry in 2025. So they don't want that turning into real shares of the company. They want to keep the dilution low. And so they're issuing this $1.1 billion of non-convertible debt, which would be at a much higher coupon rate, right? But at the expense of saving those fully diluted share counts, which makes the stock look a little bit better. However, they do have a higher, expense to pay for this loan in particular. Okay. Either way, stock up 2.2% on the day, $73 a share. Pretty freaking exciting. This is one that we're going to continue to cover in great lengths on the channel. I'm going to be bringing it to you guys more and more often because I think Shift4 is in a very unique position. But if you want more details on that, you can find some Shift4 content, available on the online from me. I just saw C-Ray say, Tanner, your last video was fire. Editing was on point. Thank you. That video is taking off right now comparatively to my other videos. It's my highest viewed video in my last 10 at this point in the release, which is like 2 hours ago, something like that. So if you guys haven't seen that, you can check that out afterwards. It's a video on SoFi, more SoFi content for you guys. And by the way, this week, in terms of the content that I'm putting out, is going to blow you guys away. It's going to blow you guys away. Hit that freaking bell. You're not going to want to miss what I have coming up next. Hopefully, it's ready for tomorrow, but it might get delayed till Wednesday. I'm not sure, but it's going to be crazy. Hopefully, I can post early tomorrow. That'd be great. And then do new bank earnings tomorrow later in the evening. So yeah, tomorrow, by the way, guys, all new bank. 100% new bank. We have like a 2-hour long earnings results, and then also I'm gonna be recapping it and everything with you guys. Now, the earnings live stream is going to be going live at 5:50. only giving me 10 minutes before the call to review the entire quarter. The reason why I did that is because they literally do it in that earnings call. They break down like page by page what the results were. There's no point in me doing it at a less informed rate. Let's just listen to them. I'll be listening along with you guys. But aside from that, I'm just going to be going on 10 minutes early to just talk about the share price and where that potentially has moved to. So that's all. All right. Now, on to the beautiful SoFi. This is what you guys want. Let's do it. Noto is coming on. I wish. I'm hearing some executive interviews coming. I wish. Okay. Let's listen to some Bloomberg. And yes, I'll probably lose monetization because of this, but that's fine. This is for the SoFi gang, and I appreciate you guys all being here.
Gears now. Fintech giant SoFi boosting its 2024 profit forecast for the second time this year. The company's CEO, Anthony Noto, having this to say this morning, that despite the rate environment and our conservative stance in lending, we drove sustained strong results in the quarter and are ready to move quickly once things improve. Anthony Noto joins us now. And you look at the results this morning, Anthony, you look at the way you've been diversifying SoFi tech platform, financial services, things like SoFi Money, really driving SoFi forward here. What does SoFi look like in 5 years from now? How quickly can you diversify this to make that financial services tech business more than half, more than 3/4 really of your platform?
Well, thank you for the question. And also thank you for recognizing the tremendous transformation we've made from being predominantly lending to being financial services products and tech platform. Over the next 5 years, I would expect our growth to result in revenue that's about 30% financial services revenue, 30% tech platform revenue, and 30% lending. The business that's growing the fastest now, and that's increasing as a percent of revenue the fastest, is the financial services segment. We had a record revenue for the quarter at close to $600 million and 22% growth. And it was really driven by that financial services segment that grew 80% year over year and is now starting to reach a scale at about $170 million of revenue. It's benefiting from 58% growth in AUM in our invest business. It's benefiting from deposit growth of 80%. And it's benefiting from high interchange revenue growth as well. And of course, 40% product growth in that segment. So that'll be the horse that we continue to ride to drive the diversification. Mm-hmm. The second element would be, as you mentioned, the technology platform business, which we believe is a mid to high teens grower for the rest of this year, for the full year, I mean, and then going to 20% growth next year as we have a great backlog of partners coming online, hopefully in 2025.
Anthony, one major question is around interest rates. If you do see the Fed cut this year, then what does that 4.6% APY on your SoFi?
Just really quickly, I'd love to have this face right here, this beautiful face. The man, Anthony Noto, on the channel. Anthony, please hook us up, dude.
Money product look like moving forward? If it lowers, how competitive do you have to be to keep that money flowing in?
Yeah, we think we'll still have a very competitive APY in a declining rate environment. Several of our businesses will benefit meaningfully from a lower rate environment. The loans in our balance sheet will be worth more, everything else equal. Home loans will actually see more refinancing, and that business should benefit for greater demand, greater marketing efficiencies, greater flow.
Let's talk about the fair price of loans real quick. He said, the loans on our balance sheet will be worth more, right? Remember, I try to explain this all the time, but for the people who are newer to investing or newer to following these types of bank or lending products, there is a certain amount of rate that they receive from people paying their interest or paying back their payments on those loans. Okay, in a risk-free environment, in every environment, there's some sort of risk-free rate. Okay, right now it's anywhere around 5.5%. Okay, that is the benchmark rate for saying, hey, we can get freaking T-bills that we know at a very high likelihood we are going to get our money back. It's not actually risk-free, but it's dang well close, okay? So why would we go out and try to buy up some of SoFi's loans if they're also going to be at 5.5%? Well, clearly they're not, Okay. They're at a much higher rate. And so people are willing to take on the risk that personal loan borrowers might not pay back for the chance of that higher rate that they could be receiving over time. Okay. But the thing is that if that risk-free rate starts to come down, people want a higher rate. And so the loans that we've locked in for 2, 3, 4 years of these personal loans over time, making these high coupon rates. I'm talking like 14%. Okay. As that risk-free rate starts to come down, the spread between the risk-free rate and SoFi's, entire balance sheet or their book of loans is going to look better and better. And so the buyers of loans, which can be, other financial institutions, other, hedge funds or something that might want a little bit of a fixed income play, or insurance companies or anything like this, may want to go out and buy SoFi's loans at a high, like they'll have to pay SoFi a higher amount, not all the way up to 14%, but they might have to pay a large percentage of that spread. So then they can get that little bit and SoFi can get a little chunk of that spread as well. So essentially, as the risk-free rate comes down, or as interest rates come down, SoFi's loan book will look better and better over time because the large bulk of the loans that we have written have been at the highest interest rate possible.
Through also our student loan financing business would benefit. That will all allow us to continue to maintain a very high APY relative to competition. Many of our competitors that offer an APY that's even close to ours, we're at 4.6% if you do direct deposit. We're still superior to others, but those that are close to us will struggle to keep the same rate and the same.
B-Dub said they should have accelerated lending then ahead of rate cuts. Well, I mean, they did, right? They're saying that the revenue is going to be down, but they've originated the highest amount of loans, 5.3 billion this quarter. Okay. So they absolutely are accelerating lending. Forget the commentary, look at their actions. So I think that is important. They definitely are.
Premium because they're not origination platforms. So we benefit from both those businesses working well together.
What do you think, Anthony, Wall Street isn't seeing that you do in terms of your potential? Because the shares, they're off a little bit today, and I guess it really doesn't matter what happens on one day. But since the IPO, they're down 30%.
Yeah, I'd say the biggest thing that's not being recognized is the tremendous scale that we've achieved in a financial services segment and the growth that it's contributing. The fact that we hit record revenue and 22% year-over-year revenue growth in our lending business, the original business that was 99% of the business when I joined in 2018, only grew 5%. We were able to grow 22% year-over-year with a record revenue, and the oldest business we have only grew 5%. That is a fact that's hard to deny, and one that really exemplifies our transition to being a less risky, less capital-intensive revenue business, and we just have to keep executing on that. I do think over the coming days and weeks, as there's more clarity on rates from the Fed, more clarity on lending performance, et cetera, it will start to be recognized.
It has not been good since IPO, but like I always say, and I sound like I'm beating a dead horse, and while the stock stays down, I definitely am. Like, it's definitely not fun to hold this through all of these quarters and not see results. But this is whenever we look fundamentally and we say, hey, how are there companies that we're actually buying performing, right? Is there a chance that Wall Street is eventually going to give the credit to SoFi, not just based on something like 1x tangible book value, but properly valuing it somewhere near the rest of its fintech competitors? Some analysts say yes, right? What was their name? Or his name? Manny Liu put an $11 price target on SoFi. And the reasoning for that was just saying, hey, we want to price it near any of the other fintechs, not looking at banks. It's not like it is a bank, but we're not looking at it like it's a bank. They're much faster growing and deserve a premium for that. Potentially, depending on the macro, that is how the market will fluctuate. Remember, all the way back in time, SoFi was valued at a $25 price target with the exact same business model, if not less, advanced than what they are today. Why? Because the market was willing to take larger risks on smaller companies. That will come back eventually. I don't know when it will be, but it usually has to do with rates, because if there's no risk-free rate, then a lot of money ends up pouring from money market funds into equities, allowing people to, buy up the Mag 7s, everything like this. But then that starts to trickle down as people realize that they can't get the same valuation and that there might be better plays in something like Russell 2000 stocks that might have been sort of left at the table whenever people were deploying capital. So SoFi will definitely be on that list of extremely linear, fast-growing companies that is in an industry with such a large total addressable market, and obviously, like I said, very linear growth, safe sort of in that environment, but yet not being placed with the rest of the banks. That's my hope.
Actually saw a decline in our delinquencies for personal loans for the first time since they started going up after the pandemic, and that's an important inflection point that people should also start to recognize.
I want to talk about the contours and the makeup of the business going forward, because you talk about this diversification. It seems like investors certainly.
As you said, you SoFi bank holders chased the wrong company, should have bought new in the 4s. I was there whenever new was in the 3s, okay? And I did buy it at that price. You can go all the way back in January of 2023, whenever I freaking said that I was buying the company in the 3s, okay? It wasn't that clear that this company was going to run up the way it did. The reason why people can say, oh, look how easy of a pick this was, is because it did what exactly it did. Okay, there was a ton of geographical risks. I was able to take a small bet on that company whenever it was at that price, and then made significantly larger bets all the way up until about $8. Okay, but those weren't obvious at the time. So all these people that said you should have, oh man, you should have bought Nvidia. Okay, it's not clear that that would have happened. Nvidia is my largest stock in my portfolio, and I can confidently tell you I had no idea what was going to happen with AI in the boom of Nvidia. Okay, and I'll do this with SoFi too. As it starts to rocket up, if it does, okay, I am not going to sell out, and there will be a bunch of people who do. This will be the saddest thing about SoFi. If it does what I think it'll do eventually, is that a bunch of people won't even see the gains because they're going to sell out the second it gets to $8 or $9 because they say, oh, it's going to go back down to $6. It's done it for an eternity. It did this on the way down. Go back in history and look at SoFi's price. It never dropped below $14 a share back in the early 2021 era, right? So there would be a bunch of people that whenever it dropped down to 14, they'd buy and they'd expect it to go back up to 20, okay? Until that breaks. So technical analysis only works looking retroactively. It's very hard to predict the future. Some people do. I know micro to macro is an extremely good, person for buying based on technicals. I'm not one of them. Play to your strengths. My ability is my age and my ability to see stocks over the long term. I've done it before. I'll do it again. I'm going to do it with this company. But yeah, the thing that I'm just trying to advocate for is all the people that said, hey, shoulda, coulda, all they're doing is picking stocks retroactively and saying, these are the ones that went up. You should have bought that. The one that you're buying back then didn't work, and that's why you are dumb. It's like fundamentally the company is still killing it. Okay, it's still doing great. It'll see its time in the sun.
Like that less emphasis on personal lending in particular. I mean, looking forward, where do you see personal lending falling in terms of how big of a business it is for SoFi?
Yeah, that business, the volume we did in personal loans in the quarter was up 12%. As I mentioned, all of lending revenue only grew 5%. Student loan refinancing and home loans actually had great quarters. Home loans had 71% growth year over year, and student loans 86% growth year over year. So the personal loan piece will probably stay pretty consistent with the guidance that we've given. The other two businesses in lending could do better if we continue to see an improvement in the economy and rates coming down. But their overall lending business is going to drop to about 50% of our revenue, and non-lending be 50% by the end of the year. Today, it's about 57% of our revenue lending is.
Anthony, I think it's pretty fair to say here that investors are kind of concerned about credit quality at this part in the cycle. How do you kind of categorize the cleanup work you've had to do in your portfolio to get to the place where you're comfortable with the go-forward loans you're extending?
I think that this is important too, and also goes to the price of SoFi stock. Is like he said, back in the day, or even whenever he joined the company, lending was 99% of their entire revenue. It was important that the credit would stay at the most pristine value. Like that's how the company made its money. Today, it's all the way down to 57%. It's still a massive chunk, but it is significantly less reliant on the credit quality of their users than it was before. And I'm speaking as if their credit quality has gotten any worse, and it hasn't. So anyway, I'll jump back to the video, but it's just important that this story about, the only thing that matters is the default rate is actually becoming less and less the case. If it gets down to a 50-50 mix between, capital light business of technology and financial services and versus the 99% or even 82% whenever it first became a public company, those are two very separate ways to value a business over time. So it's just important to think about that.
Yeah, we haven't had to do a lot of cleanup work. We've had to stick to very tight credit standards. We did tighten our credit box late last year. We're seeing the benefits of that now. As we mentioned on our call, our delinquencies, which are a leading indicator of losses, hit a peak in March and have come down in the quarter sequentially on an absolute dollar basis, as well as percent of revenue. So that's an important inflection point. The second thing we provided information on was vintage analysis. And you look at our total portfolio of loans, how much of the unpaid principal balance remains and what's been lost to date, and then what could be lost in the future. And that vintage analysis shows very clearly that we're likely to be well within our tolerance level of a lifelong loss of 7-8% for our loans over their lifespan. So it was an important additional disclosure that we've made, and I would point investors to that as well as the trends in delinquencies.
It's a shame because Shift4 has just put out a recent quarter, and they showed off a ton of slides to specifically go after analyst, qualms about the company, and the stock is starting to get rewarded. I mean, it's still not where I want it to be. Analysts are placing that stock anywhere between 80 to 90 something dollars a share. I think some of the higher end ones like $94, $96 a share, whereas SoFi is just, as you can tell, still not getting the love, even though they are addressing a lot of the analyst concerns.
The area that you're in is a hot one right now. Gen Z and millennials are, I think, very interested in finance and taking care of their finances responsibly. How much is it to acquire those kind of customers? I mean, they have now so many other choices.
Get ready for the dodge of a lifetime?
I just came from Europe, so N26 and Revolut, but also Marcus and SoFi. How much do you spend for each customer?
How much do you spend for each customer?
Yeah, every product is different. We're GAAP profitable.
That was his answer.
Well, this was our third quarter of GAAP profitability. Our EBITDA, or a good proxy for cash flow, EBITDA less CapEx, has continued to grow very nicely. It was up 80% year over year to $137 million. A big reason why we're seeing such improvement in profitability while seeing such growth in members at over 40%, products at over 40% growth, and revenue at 22% is marketing efficiencies. Crystal Point, our CFO, mentioned on the call that marketing as percent of revenue improved by about 7 basis points on a year-over-year basis. 40% of our product growth is from existing members, which means we don't pay a second customer acquisition cost. It's a huge competitive advantage to get that second and third product at no customer acquisition cost. Gives you great leverage. For us to be successful, to become a top 10 financial institution, which is our goal, we have to become a household brand name. And we measure our success in that area based on unaided brand awareness. And we've achieved about 7 to 9% unaided brand awareness.
The quote said 79. It's 7 to 9%. Okay.
In the most recent period, which is up 4x from where it was back in 2021. So we're making great progress.
Anthony.
Our marketing team is hitting the ball out of the park as it relates to our ability to build that brand awareness and drive adoption.
Speaking of marketing,
before she gets into the next question, there was a part that what was his name? TJ the Wheel Deal said on X today. He said, I want to know, let's do a poll. How many people have actually signed up for SoFi because they saw SoFi Stadium? And I think that that's not the question at all. I mean, I hope that's zero, right? There's no one that passes a TD Stadium or a JP Morgan Chase and goes, you know what? I do need a bank with JP Morgan Chase. I think it's more on the idea of the next time that you see a SoFi ad, a Bank of America ad, a Chase ad, that the back of your mind, subconsciously, you do know that company already. You have this level of trust because you know that they are part of this much larger organization, that they are real. They have a physical branch in a way, right? So it's not necessarily that SoFi Stadium or something like this, or the TGL deals or NBA deals directly translate to signing people up. I mean, the NBA deal technically is a little bit different because they have those sweepstake things to sign up and actually get rewarded. But the SoFi Stadium, that name is not there to initially translate people into users. It's to build that unbranded or unaided brand awareness. And then the next time that SoFi comes to you with an offering, you are much more trustworthy to put some money with them because you know that they are a much larger institution.
There is another deal in the market right now that is the Pershing Square USA closed-end IPO fund, and you are one of the partners on the deal here. How important is it to you to be on this deal, particularly because of the retail interest involved? What does this look like for you?
Sure. Our SoFi Invest strategy overall is to give Main Street investors access to what high net wealth and hedge funds and institutional investors get access to. So when we launched SoFi Invest, we actually launched with stocks without commissions. We pioneered fractional shares. We launched with a number of ETFs that allow people to diversify their investment, do dollar cost averaging at low price points. We have robo accounts. In addition to that, we have alternative asset classes. You can now buy private credit, private real estate.
How much does private credit, private real estate, and venture capital make up for SoFi? About 12% of the SoFi Invest platform. Okay, which is kind of interesting. All those private new funds that just came in bring in about 12% of net inflows. So not insignificant, which I thought was pretty interesting. I would have thought it would be even smaller than that, but yeah.
SoFi, in addition to that, IPOs. And so we're offering IPOs at the IPO price to Main Street investors. I can't talk about any particular IPO, but IPOs are a part of our overall selection, differentiation in Invest. In addition to that, we're ready to roll out a directed share program for those issuers that want to provide.
Here, listen to this. Let me go back for a second. I'm just going to go back the next 5 seconds. Listen to the new product that they're rolling out right now. Very interesting.
We're ready to roll out a directed share program for those issuers that want to provide IPO access to their employees and their partners. They can do it in a turnkey way with SoFi in the most scalable directed share program that I've ever seen in my professional career. Someone can sign up, make a deposit, put an order with no minimum balance and no fees.
Think about that. That's like SoFi at work, okay? Going to other institutions and saying, hey, you're going to need a SoFi account in order to take advantage of this extremely customer-centric way of, delegating out some of your shares to employees and partners and, family, whatever the heck you end up wanting to do. Not, they're not running entire IPOs, but it's an easy way to do that. No fees, no minimum balances, all that stuff. It's an amazing opportunity to get SoFi in the hands of people that might just need it for employee benefits.
An amazing professional career. Since you graduated from West Point, you've had a huge breadth of experience on Wall Street and in business. You've been working with SoFi or social finance throughout the last couple of terms. And I want to ask you for, all the CEOs who watch Bloomberg and don't have the experience that you do. We could get back to a Trump administration after November, or we could have, Kamala Harris, which in some ways would be an extension of the Biden administration. What has been different about those two operating environments that you can share with us?
I love this. I like how this guy puts a little respect on my boy Noto's name, because a lot of people I see in comments that don't know Anthony Noto very well, they're like, oh, he doesn't know how to talk to Wall Street. This dude was born in Wall Street, okay? He was one of the best analysts of all time on Wall Street and retired from there because the IPO that he ended up putting through, one of the most successful ones, was Twitter, and then they ended up hiring him there as a CFO based on his activities that he did IPOing them in the first place. Okay, so dude's a Wall Street lifer.
Sure. Thank you for the question. So we've operated under both types of administration, Republican and Democrat, since I joined the company in 2018. The fact of the matter is we're building a durable business that is based on achieving financial independence for our members by being a one-stop shop for all the major decisions they make in their lives and all the days in between. And that's a lifetime relationship. So the reality is we're going to operate in, whether it's Republicans or Democrats, in a great way. On the margin, are there more benefits to capitalism, to M&A, to market activity with a Republican versus Democratic administration? Historically, there has been a lot more capital markets activity, M&A, et cetera, with a Republican versus Democratic administration. But there's also stronger social programs with Democratic administrations, which SoFi can uniquely help with, given our financial education, our Community Reinvestment Act capabilities, et cetera. So we can operate in either environment. There are pros and cons for each. Generally, I'd say with the Republicans, a lot more M&A activity, a lot more market activity, and with Democrats, a lot more social activity, both of which we can play in.
All right, Anthony, thanks so much for joining us for this interview, and thank you for your service as well.
Ladies and gentlemen, that is the interview. But I thought that was good. You know what? Ended up getting a couple more insights from Anthony Noto and spreading the word on different places, but more mainstream capital or like what do you call it, financial news. But bring some to retail, brother. Come on, give me 10 minutes, like what you did there. Quick 10 minutes, get your points in, talk a little shit with me. Goldman is about to pump SoFi very, very soon. Why do you say that, Danny? Why do you say that? This is the non-political answer that we need from Noto. Keep this up. Yeah, I don't think that he's been a very political guy ever. Even in the last thing where he said that Trump would end up benefiting his his company more. I think he said that as well. Like, more capital market activity and more M&A activity versus social programs. I mean, he can benefit from both, but I think capital market activity is going to move SoFi stock. And that is fine either way. I mean, SoFi has grown over the last 4 years as well. And it'll grow over the next 4 years, regardless of whatever side is in. Danny, hit me up with the Goldman information, dude. I'm waiting here. Now, there was some exciting stuff that also happened on Robinhood's side in terms of stock price that I thought that you guys would really enjoy. Analyst expectations. So during the Sunday sort of Black Monday event with the yen carry trade event that ended up happening, Robinhood dropped as low as I think it was 1450, something like that, and just absolutely got crushed. Stock is trying to climb all the way back up to $18.54, up 3.5% today. And it's partially due by analyst exciting expectations for the company. So let's just take a look really quickly. Piper Sandler ended up giving them an upgrade to an overweight position, slightly because of the pullback here, but let's take a quick read, okay? Shout out to Seeking Alpha here. Longer term, we expect Hood to benefit from 1, continued growth in global retail and derivatives trading, 2, the generational wealth transfer from baby boomers to their children, 3, a strong position in crypto, and 4, international expansion where Hood is still in the early stages. Piper Sandler raised their price target from $20 to $23 a share. Very exciting. Okay. Little 15% bump. Never hurt anybody. And then this I actually haven't read. I saw Mitch share this on X. So we're going to go through this. I have not read it yet because I was busy. but I'll go through it now. Now, B of A ends up giving Robinhood a $32 price target. $32. Okay, let's see why. Reported strong earnings in Q2 of 2024. Hood reported better than expected EPS at 21 cents versus 15-cent consensus, 16 cents for B of A, driven by record trading volumes and strong margin lending, partially mitigated by higher than expected operating expenses, but still on track to hit their reiterated, $1.9 billion of fiscal 2024 target range. With the launch of index options and futures trading expected in Q4 of 2024, as well as the desktop offering designed for active traders, we forecast a continued acceleration in client activity despite missing several key products that active traders value. Organic growth exceeds 40% for second straight quarter. Net deposits grew 41%. We already know all this. Let's see what they said, though. I'm not just looking to go through all the numbers. We believe that Hood is missing some key capabilities, including the ability to custody mutual funds, fixed income products, and CDs. Longer term, Hood has positioned itself well in the fastest growing segments of the brokerage space, self-directed retail. We expect them to continue benefiting from both total market tailwinds as well as increasing market share from competitors, giving their competitive pricing. $0 commission, options trading, industry low margin loans, 5% cash sweep for gold. I know another company that does all of that and better. Ayo. And strong investor community and highly rated user experience and interface. They reiterated and increased EPS estimates. Okay, so they ended up increasing their 2026 EPS from 130 to 145 and 12 cents for Q3 to 19 cents. Wow. I'd be interested if they can end up beating that as well, because I don't know. I guess Q3, like, what is the big tailwind? Is it just because we're going into September and everything? Is that their expectation, that there'll be lower volume? Yeah, I can't be showing you guys my notes for the other stories, even though this is the last story. So that was the 4 stories. We remain bullish on Hood given rising retail engagement and accelerating organic growth, positive operating leverage after large expense reductions, and attractive valuation following increased EBITDA to EPS. While the Hood stock outperformed over the last 12 months, it's still down from the post-IPO levels of 2021. Hood operates in a big total addressable market and has a long runway of growth within self-directed retail and crypto globally. Interesting. Love it. Happy to see it. Awesome. Okay, Danny. They are past the fixed costs. Everything is gravy now on incremental margins. This is where Goldman comes in when the risk is gone. I hate you guys. Why did they raise all their estimates and put out a note to private bank clients to load? Because I believe Goldman will take any opportunity to make a lot of money, and Noto is connected to Goldman, is as connected to Goldman as it gets. Just a hunch. Okay. I want to see this private note to bank clients to load. Ooh, Jared originally sold his 1968 Camaro in January to buy 8.5 thousand shares of SoFi, and now I'm cutting my losses. Dang, man. Dang. What are you going to buy, a new Camaro, or are you buying a different stock? Seems like institutions loading and retail is selling. It's not going to be me. Okay, thanks, buddy. Appreciate it. Me and Danny are on a texting basis, okay? You guys don't understand. If I can't sleep at night, I call him at 2 a.m. and I just say, hey, Danny, like, can you send me that Goldman report again? I'm having nightmares. And then he hooks me up with some institutional thing that he ends up getting somehow, and I fall right back asleep. Keep an eye on those institutional numbers. Here, let me give you guys a taste. Oh, wait, I think I was doing that last time, and then I couldn't end up remembering how to get through Fintel to find it as quickly. SoFi Institutional Holdings. We will see. I don't know. I can't find it. I don't want to waste all your guys' time. It's 44.06%. Yeah, but I like the graph of it climbing over time. You think someone who sells their car would have more conviction? I mean, hey, he might need to pay for some things. I don't know if he said that he's buying a new stock or something. But yeah. Started my first position recently with 2,500 shares and intend to load 2,500 more per share. That's a DCAer right there. You like a chart? What? Oh, man. Yeah, but I was just going to say here, if you are DCAing into SoFi and you believe in the business, that might be a way to sort of be a little bit more calm with the stock price. And, you know, I don't know how consistently you're going to DCA, but if I were you, I'd be buying regardless of the stock prices at 8 or at 6. If you're going to have that mentality of consistently buying per quarter, then just buy per quarter. Two-year options look good for SoFi right now. I mean, we can never anticipate the market. This is one thing, like, I don't know, man. I don't know what's going to end up happening. What I do like doing is holding on to shares that I know do not have an expiry and that I will consistently hold a larger percentage of ownership in this company. Well, not if it continues to dilute, but I think people worry about the dilution way too much. This is a very young, growing company. That's what they do. You know, there have been a couple moments in SoFi's history where they've accelerated dilution through Technisys or through, convertible note offerings, which will end up getting wiped away anyway. But like, do you want SoFi without Technisys or SoFi with Technisys? I want SoFi with Technisys. It solidifies the tech platform being the AWS of fintech, and it lowers SoFi's own expenses. And then if SoFi has less expenses, remember, all we're doing is playing with cash and debts. All right, that's the game that we're playing. So if we can end up saving more in expenses and keep more cash, or with that convertible note offering, like getting rid of all the preferred shares, and we have $40 million more a year, they can do two things with that: accelerate the growth of the business or pay it back to shareholders. So in one way, you can get rid of those expenses and then immediately give it back to shareholders, or look for more growth. It's not like they're putting it in their own pockets or something. What some people are saying, like, oh, look at Anthony Noto lining his own pockets. Like, dude, he's buying the stock with his own cash and then diluting as well. He's diluting himself during that process. 99% of growth stocks have been grown based on giving the employees a percentage of the business as well, so they feel like owners and go to work with a mission-driven statement. They're not going there for a salary. They're going there because they're working on their own business. Noto would be making 10 times the money as an investment banker. He could be. He definitely was making a significantly larger amount of money at Goldman than what he's making today. 10, I mean, I'm nitpicking to say that 10x is high, but 5x, he was definitely making 5x. I keep thinking I've maxed out my SoFi position, but I keep adding, hey, but maybe like I'm not trying to pick on you here, but also though, there is a limit to what percentage a single company should make out of your portfolio, right? I mean, at least the way that I play it. There's other people, like I talked to Amit, he owns 2 companies. So, but for me, what allows to get through droughts like this is that this isn't my only company, you know? So maybe you have maxed out your SoFi position, then you should look to build a different position, potentially in a different sector. Why add to a losing stock? Because if it turns, because there's no such like, what's a losing stock? That doesn't, like, you're saying that if there's winning stocks and then there's losing stocks. There are companies that can go bankrupt and go to zero. There are companies that don't grow fast enough, and so their businesses don't outperform the S&P 500. That would, maybe you're considering that a losing stock. But SoFi grows faster than most companies on the S&P 500. The stock doesn't, not currently, but those turn around. You know? What's the Ray Dalio quote? To be successful in markets, you have to bet against the consensus you have to bet against the consensus and be right every time. I think that's a Ray Dalio quote. So if you're betting on every stock that retroactively has gone up, how do you know when that run has stopped? Are you buying Nvidia at 135? I mean, it's easy to say now because it's dropped down a little bit that you would say, hey, no, I wouldn't have. But as it was running up, is that the stock to buy? You should buy the company that you think in the future will be the larger running up stock. That is not a clear outcome. So B-Dubs is saying, give us the Peter Lynch quote. I like how me and B-Dubs are, he's my best friend, okay? I know, I almost just said his name. I know B-Dub's name, but that's all I know about him. But this dude he watches me to just get his own opinion spat back at him. Ooh, tell him this thing I already know. But he's talking about the 100% long-term conviction thing. I need to find it. It's something like in a few months or a few quarters or even a few years, stocks can be disconnected from their fundamental value, but over the long term, they never are. The 100% of the time, they line up with their fundamental value. And there's also a Jeff Bezos quote that I really like, which talks about how there has never been a disconnect, not once, between customer value and investor value, right? If you do right by the customer, you are doing right by the investor. I think he said customer interest and shareholder interest is what he actually said. I'll do a little thread of like on X of like my favorite things that keep me sane in markets. And you're going to see a lot of Don Valentine, Peter Lynch, Ray Dalio, Warren Buffett. It's like not a whole lot of names you haven't heard of, but there's a reason why those are the go-tos, because they'll keep you really calm and really sane in markets. You don't need to find all these obscure people to say different things. Now, what I do like about markets, like I saw, well, 2 things. One, Graham Stephan said this really weird thing where he's like, all my content could be summed up in like 6 videos on how to be a good investor, but I make hundreds because people need it repeated. And that's really what I feel like my job is here. It's like, I just need to reassure people to be like, hey, This is still the company we're owning. Okay. Like the sky is not falling. Relax. Okay. It's not a whole lot of institutions that lost their shirt on Monday. It was a bunch of retail people that thought that stock markets were no longer an investable market. They are. Ladies and gentlemen, thank you all so much for watching. Really do appreciate your time. If you want to support the channel, I've got affiliates down below. You can click on one of those or hit the subscribe button. But that is me. Hopefully, I can deliver you guys a very fun video tomorrow or the next day. It's going to be this week. Thank you all so much for watching. Really do appreciate your time. Bye for now.